All right, we're going to be working some of these questions from previous exams. Um, I'll try to work the 10 most missed questions, and then I'll probably go back and work 10 other questions. So maybe we'll work 20 questions from each of the 3 exams. So let's do exam 1 first. We'll start with, we'll do version B. The matching concept most significantly influences which financial statement? So question 2 here. We talked about the matching concept when we talked about matching revenues to the expenses that cause those revenues, like matching sales revenue with cost of goods sold expense reported right underneath it. That's an example. And so the income statement. Let's do number 3. Recognition of revenue earned on account. Revenue goes up when we recognize it, which implies net income is up, which implies retained earnings is up, which implies stockholders' equity is up. And then on account, that means we have an account receivable with our customer. We do stuff for them, but they don't pay us. Revenue on account. So account receivable up, which means assets goes up. So C and D are both out because they have assets going down. And A and B both have assets going up, but A doesn't have revenue going up and net income going up. So B must be the correct answer. Number 4, which of the following answer choices accurately reflects how the recording of accrued salary expense at the end of the year affects the financial statements of a business? Salary expense is up, which implies net income is down, which implies retained earnings is down, which implies stockholders' equity is down. And it's accrued, which means our employees have worked for us. We owe them salaries, but they haven't paid us yet. No cash yet. So that means salary payable. We have a salary payable with our employees. So that goes up, and that's a liability. So liabilities are up. So B and D are out because they have no effect on liabilities. A and C are candidates because liabilities are going up in both of those. A is ruled out because A has cash being affected, and cash isn't affected. So it's C. Liabilities are up. Expenses are up. Liabilities up, expenses up, which makes net income down, which makes retained earnings down, which makes stockholders' equity down. No effect on cash. Let's do 6. And let me keep track of the ones I've done here on a new sheet. Make sure after I've done 20 of them, then I'll stop. So we did 2, 3, 4. Now we're going to do 6. Prior to closing the accounts, the accounting records showed the following balances. After closing the accounts, the balance in retained earnings is what? This is testing your knowledge of closing the accounts. So the accounts that get closed are the temporary accounts, the revenue accounts, the expense accounts, and any dividend account. And those get closed out. They all get closed out to retained earnings. So retained earnings before closing has a balance of 8,000. And then when we close out the revenue account, that increases retained earnings is balanced. We put the revenue into retained earnings and revenue goes to zero. Interest revenue, same thing. The expense accounts, those are reductions from retained earnings. And dividends is also a reduction. So after closing, retained earnings has this balance: 8,000 plus 8,850 plus 1,400 minus 50, and so forth, and you get the answer like that. Let's do 7. We're going to try to do 20 questions. I'm just using this to keep track of which ones we've done. Following account balances were drawn from the financial statements of Grayson Company. Looks like these are all assets over here. Based on the above information, what is the balance of common stock for for Grayson Company at the end of the year? So every number here is an end of year balance, except for this number. That's a beginning of year balance because it says January 1st. So we just need to use our equation: assets equal liabilities plus common stock plus retained earnings. The assets balance at the end of the year, 5 and 2 is 7, and 8 is 15,000, and then 100, 200, and 700 all add up to 1,000. So the assets balance is 16,000 at the end of the year. Liabilities, there's only one of them, accounts payable. Common stock, that's what we're trying to figure out. And retained earnings balance at the end of the year, we don't know. This is the beginning of the year balance. So we need to get the retained earnings balance at the end of the year. So we'll use a second equation, the retained earnings equation, which states that retained earnings at the beginning of the year plus net income during the year minus dividends during the year equals retained earnings at the end of the year. And then we can plug that in here once we solve. Retained earnings at the beginning of the year is 3,400. Net income during the year would be the revenues, which were 10,200, minus the expenses, which were 7,600. And then subtract dividends, which are 0 because they don't give them to us. It must be 0. So retained earnings at the end of the year, is 6,000. So plug that in for this. And so we have assets equal liabilities plus common stock plus retained earnings. And then common stock, we can solve for common stock. 16 minus 1.6 minus 6. Let's do 8. Which of the following is false regarding managerial accounting information? It can include non-financial information. That's true about this. It focuses on divisional rather than overall profitability. That's true. D, it is more detailed than financial accounting information. That's true. C, it is often used by investors. That's not true. Investors are those outside the company. And we know that managerial accounting information is used by insiders, not outsiders. Let's see. Let's do 10. The Heritage Company is a manufacturer of office furniture. Which term best describes their role in society? The PowerPoint slide that this is testing is that slide where we looked at the resource owners. These are the people who have the money. They give their money to businesses or companies. And the businesses take the money and convert it to finished goods, which they then sell to consumers. Consumers buy the products. And so, since the Heritage Company is making a product, then they must be a business. Let's do 12. Excuse me. Let's jump straight to the question since there's so much given information here. Based on the information alone during year 1, which of the following statements is true? And all the statements are about total assets. So, and this is year 1. So the beginning balance in total assets is 0. And they're wanting to know the change in total assets. So beginning total assets are 0. January 1st, we got 31,000 cash from issuing stock. So assets go up by 31,000 because it's cash. During year 1, we earned $10,100 of revenue on account. So accounts receivable goes up by 10,100. That's an asset. So this is cash. This is accounts receivable. Then we collect 9,200 cash on accounts receivable. So cash goes up by 9,200 and accounts receivable goes down by 9,200. Those are both assets. But the net effect of that is no effect on assets. And then we pay 7,000 cash for operating expenses. So there's another reduction in cash. And so this is all the effect on assets. And so the change in assets, so our end of year balance would just be 0 plus 31 plus 10.1 plus 9.2 minus 9.2 minus 7. 34,100 is the ending balance. And the beginning balance is 0. And so the change is positive 34,100. Let's do 14. Which term describes assets that are generated through operations that have been reinvested into the business? So funds that have been earnings that have been generated from our operations, from selling our products and services to our customers, that we've reinvested back into the business. That's retained earnings. So I did 12 as well. Let's go ahead and do 15 now. Anytime you see this much given information, just jump straight to the question. What is the net income for year 2? So all this information is about year 1, not relevant. The following transactions occurred during year 2, and we want net income in year 2. Net income is always revenue minus expense. So we want the revenues minus the expenses, and that'll give us our answer. So the first thing, when we get cash from issuing stock, that's not a revenue. We can't have revenue from our own in shareholders. We got money from the bank from borrowing money. That's not a revenue. We earned 9,000 of revenue on account. That's a revenue. We incurred 4,000 of operating expenses. That's one of the expenses. We collect cash from accounts receivable. That's not a revenue. Revenue only happens when we ship goods or provide services. collecting cash. We've already earned the revenue in the past if we're collecting cash on accounts receivable. So this is not a revenue. Provide additional services to customers for $1,000. That's a revenue. Purchase land for $14,000. We bought something, but that's not an expense. An expense only happens whenever we derive the benefit from using a resource. Use $3,000 cash to pay off part of our accounts payable. That's not an expense. Declared and paid a $200 dividend to stockholders. That's not an expense. Accrued salaries as of December 31st are $4,000. That's an expense. Our employees have worked for us. We've derived the benefit from them working for us. We have salary expense. So the revenues are $10,000. The expenses are $8,000. So the net income is $2,000. Let's do 17. Stosh Company's balance sheet reported assets of 137, liabilities of 34, and so forth and so on. There's a lot of given information. Let's just jump down. What's the amount of net income for year 2? It's the same question as before. Net income, again, is just revenue for the year minus the expenses for the year. So all this stuff about assets, liabilities, not relevant. Well, it may be. We'll see. So this question asks for net income but doesn't give us the revenues and the expenses. So we can't go about finding net income this way. So what's another way to get net income? The retained earnings equation. Retained earnings at the beginning of the year plus net income. You see net income's in this equation. Minus dividends equals retained earnings at the end of the year. If we can get this, this, and this, we can solve this equation for net income. And so that's the way we're going to do it. So at the beginning of the year, beginning of year 2, well, let's see. We don't have retained earnings at the beginning of year 2. It doesn't give it to us. We don't know net income. We know dividends in year 2 given to us. And we know retained earnings at the end of year 2. So we need to get retained earnings at the beginning of year 2. This is year 2. Retained earnings at the beginning of year 2 is the same as retained earnings at the end of year 1. And this first sentence is about year 1 stuff. So at the end of year 1, our accounting equation, assets equal liabilities plus common stock plus retained earnings. We got 137 in assets. We got 34 in liabilities. We have 31,000 in common stock. And what do we have in retained earnings at the end of year 1? We can figure that out. Looks like retained earnings at the end of year 1, which is the same thing as retained earnings at the beginning of year 2, will just equal 137 minus 34 minus 31, so 72. Now plug that in up here and then solve this equation. So that implies that net income during year 2 equals the $94,000 retained earnings balance at the end of year 2. Add back the dividends, just do algebra, and then subtract the beginning balance. So 94 plus 33 minus 72 is 55. So we did 17. Let's go ahead. Let's do 19. How much would Gomez Company report as cash flows from operating activities? So any cash inflow or outflow resulting from us dealing with our customers is an operating activity. Also, it asks how much revenue would Gomez Company report related to this contract on its income statement, and then how much cash flows. So we collect $9,000 on September 1st, year one, from a customer for services to be provided over a 1 year period beginning on that date. So we would have a $9,000 cash inflow from operating activities. How much revenue, though, would we recognize for this contract for the year ended December 31st, year one? Since we got the money on September 1st and 4 months elapse, September, October, November, and December, 4 months elapse between this date and this date. And this amount represents a 12-month amount. So the amount of revenue we recognize is just 9,000 times 4 over 12, or a third of it. So 3,000. So we get 9,000 on September 1st. We do some stuff for people over the next 4 months to earn that money. They've prepaid us, right? We do $3,000 worth of stuff for them. We already got the 9,000, but we earn 3,000 of revenue over the next 4 months. So between this September 1st, December 31st, year one, we will have earned 3,000 of revenue, and we will have $9,000 inflow of cash from operating activities. Let's do 22. They're wanting to know our financial statements for year one would show what balance in the supplies account, and then what would be the supplies expense. Well, right here at the end of year one, we count $1,400 of supplies on hand. So the balance in supplies at the end of year one is $1,400. So that rules out D and B. We're left between A and C. What's the supplies expense? Is it $2,000 or is it $3,200? In other words, what's the dollar value of the supplies we used this period? That's the supplies expense. Right? We incur an expense when we derive a benefit from using a resource. So what dollar value of benefit do we derive from using these supplies? In other words, what dollar value of supplies do we use? So the supplies account began the year with a balance of $1,200. To that, we add $3,400 worth of supplies when we purchased them on account. We pay $3,000 off our account payable. That's not relevant to the question at hand, so ignore that sentence. And at the end of the year, we're left with $1,400 balance. So $1,200 plus $3,400 doesn't equal $1,400, which means we must have used some supplies this period. We must have subtracted from the supplies account. So what dollar value did we use? So we're just left with solving this equation. $1,200 plus $3,400 minus X equals $1,400. Solve for X. So the dollar value of supplies we used would be the $1,200 minus the $1,400 plus the $3,400, which is $3,200. So that's the supplies expense. So that rules out C, and we're left with A. Let's do 27. Actually, let's not. Let's see. We got 1, 2, 3, 4 on this page. So let's do 24. Which of the following appropriately reflects the cash transactions between these reporting entities? Jack Henry, Walt Bank, and the new store, Wooden Wheels. So what happened to Jack's cash, Wooden Wheels' cash, and Walt Bank? So Jack Henry got $800,000 from Walt Bank to open a new bike store called Wooden Wheels. He transferred $650,000 of the cash he borrowed to Wooden Wheels. So Jack's cash went up by $800 and down by $650, so he had a net increase of $150. So this is the only one that has 150 for Jack Henry. So A's got to be right. The other ones are ruled out. Wooden Wheels, their cash goes up by 650 because they get 650 from Jack. And then Walt Bank had to give 800 to Jack. So their cash goes down by 800. So A is the choice. Let's see. Let's do 27. Stanley Company earns $8,000 of revenue on account in year 1. Let's just go ahead. Which of the following shows how the recognition of revenue in year 1 will affect the company's accounting equation? So this sentence, cash collections of receivables, is nothing about revenue. So that's irrelevant. The only sentence is relevant is this. We earn $8,000 revenue on account. That means revenue up by $8,000, which implies net income up by $8,000, which implies retained earnings up by $8,000, which implies stockholders' equity up by $8,000. And then the on account part, we have an account receivable with our customer, so account receivable up by $8,000, which implies that assets are up by $8,000 because that's an asset. So the only choice of these that has assets up by $8,000, in particular accounts receivable, is C. So C has to be right. D's wrong, B's wrong, A's wrong. C also has retained earnings up $8,000, which happens right here. $28. We're going to do 28. We're going to do 32. We're going to do 37, and then we're going to pick 2 other ones. The collection of an account receivable is a claims exchange transaction. Here's the accounting equation. There are 4 types of transactions we talked about way back at the beginning of the course. We had an asset exchange transaction. That's where one asset goes up, another asset goes down. So the left-hand side goes up and down, right-hand side, no effect. We had an asset source transaction. That's where left-hand side goes up and the right-hand side goes up, either liabilities or owner's equity. We had an asset use transaction. That's where the left-hand side goes down and the right-hand side goes down. And then finally, a claims exchange transaction. That's where the left-hand side, no effect, and the right-hand side up and down by the same amount. Either liabilities up and owner's equity down, or owner's equity up and liabilities down. Something like that. So collecting an account receivable, cash goes up, accounts receivable goes down, and those are both assets. So this is false. Collecting an accounts receivable is an asset exchange transaction, not a claims exchange transaction. Let's do 29. All of a business's temporary accounts appear on the income statement. The temporary accounts are revenues, expenses, and dividends. 2 of those appear on the income statement, but dividends does not. So since this says all, that's false. Let's do 31. Then we'll do 32 and 37. Nelson Company experienced, all right, what is the net income that will be reported for year 1? Net income is only about revenues minus expenses. So we just need to find the revenues. Is that a revenue when we get $7,200 from issuing shares to our shareholders? No, we can't have a revenue with our own shareholders. Provide 3,500 services on account. That's a revenue. Paid $1,900 cash for operating expenses. That's an expense. Collected $2,500 of cash from accounts receivable. That's not a revenue. We did not ship goods or do services. Paid $160 cash dividend to stockholders. That's not an expense. We can't have an expense with our own shareholders. So that's the net income. $32. Which of the following statements is true? We earned $1,500 of cash revenue, paid $1,200 for cash expenses, and paid a $200 cash dividend. The net cash inflow from operating activities was $100. The net cash outflow for investing activities was $200. None of these things given to us are investing activities. Investing activities is whenever we sell or buy a long-term asset, like property, plant, or equipment. So these are both about investing. They can't be right. So it's between A and D. The net cash inflow from operating activities was $300. D is correct. We had $1,500 inflow from operating activities. $1,200 outflow from operating activities equals $300 net inflow. A is wrong. And 37. At the beginning of year 2, so based on the information provided, what is the balance in stockholders' equity at the end of year 2? So the balance in stockholders' equity would be the sum of the balances of these two accounts. This is one equation, the accounting equation. Let's see if this will be useful to answer the question. Oh, I see. This gives us information about the balance in common stock at the beginning of year 2, the balance of retained earnings at the beginning of the year 2, and then these transactions happen, and so at the end of year 2, what's the balance in stockholders' equity? So all we need to know is that common stock plus retained earnings is stockholders' equity. And so we're given the beginning balances in each account, $300,000 in common stock, $15,000 in retained earnings. So at the beginning of year 2, stockholders' equity had $315,000. What about at the end of year 2? Well, let's see what happened during year 2. Issued common stock for $90. That makes common stock go up by $90. Earned net income of $50. That makes retained earnings go up by $50, right? Beginning retained earnings plus net income. Dividends are $8,000 minus dividends. That makes retained earnings go down by $8. And issued a note payable for $20. That affects liabilities. It doesn't affect common stock or retained earnings. So the ending balance in common stock is $390. The ending balance in retained earnings is 15 plus 50 minus 8, which is 57. And so at the end of the year, 390 plus 57, stockholders' equity has a balance of 447. And that's it for exam 1. So we've gone through 20 questions. Let's go on over to exam 2 now. Let's do number 3. When we use percentages to compare each of the parts of an individual statement to a key dollar amount from the financial statements, that's called vertical analysis. Right? For example, we divide the balance of all the accounts on the balance sheet by the total assets. So let's make our list here. So 1, 2, 3. So we did question 3. Let's go ahead and close exam 1, version B. We don't need that anymore. All right. Let's do 5. Which of the following statements is generally not correct from an investor's perspective? A 5% dividend yield is generally preferred over a 3% dividend yield. And that is correct. A 20-day average collection period for accounts receivable is generally preferred over a 30-day. That's correct. We would rather collect our account receivables faster than slower. A 10% net margin is generally preferred over an 8% net margin. That's correct. So by process of elimination, D. A 1-to-1 current ratio is generally preferred over a 1.5 to 1 current ratio. No, that's not true. You prefer this one. Let's see. Let's do 8. We'll also do 9. A company that uses a JIT inventory system may find that having less inventory actually leads to increased customer satisfaction. And we can get this answer just by process of elimination. A and B are not relevant to JIT. Like whether you have a JIT system or don't have a JIT system, that's irrelevant in terms of assessing your value chain to create new value-added activities or adopting a systematic problem-solving attitude. You can do A and B regardless of whether you have a JIT system or not. So those A and B are not pertinent to having a JIT system or not. C is just flat out false. If you use JIT, then you have no inventory on hand, right? You wait till the customer orders and then you produce to order. So you don't have finished goods inventory on hand at all times in order to speed up. And so by process of elimination, D is correct. Even if you didn't know why D was correct, you could rule out A through C. But yeah, this is true. If you use a JIT system, you may find that you have less inventory on hand, which leads to increased customer satisfaction because they place an order, you make it based on what they ordered, and they don't get any old products or anything that's been sitting on your shelves for 3 years because you don't have anything sitting on your shelves. They get something brand new made to their specification. Like whenever somebody comes into Domino's and orders a pizza. Domino's uses a JIT system. Just-in-time inventory. Let's do 9. So based on the above information, the amount of period costs is shown on Steuben's income statement. Period costs. So product costs versus period costs. Any cost that occurs in the factory is a product cost. If it does not occur in the factory, it's a period cost. So rent on the factory, that's a product cost. Office manager's salary, so this is a product cost. That's a period cost. Wages of factory machine operators, that's a product cost. Depreciation on factory equipment, product cost. Insurance and taxes on S&A offices, period cost. Direct materials, product cost. So it would just be these two added together. 68 and 8. Whoops. Let's do 11. We operate a gourmet sandwich shop. We order bread, cold cuts, and produce several times a week. The total cost of those items is said to be what? The total cost. It's a variable cost. Because the cost to us of ordering these bread, cold cuts, and produce depends on how many customers we serve. If we only have 5 customers, we don't have to have as much bread, cold cuts, and produce. If we have a bunch of customers, we got to have a lot more bread, cold cuts, and produce. We have to spend more money. Now the cost of the bread, cold cuts, and produce total divided by the number of customers, if that's constant, well, that will be constant if the total cost is. So V times Q is the total cost. V times Q is variable, but if we divide by the number of customers, we get V, which is a constant, and that's true. So this statement right here is just given to throw you off. I mean, that's true. It's a true statement, but try to make you think that it's a fixed. V is fixed, but V times Q is what they're asking about, and that's variable. 12. We collect 5,000 on account. What impact will that have on the firm's current ratio? So the current ratio is current assets over current liabilities. When we collect 5,000 on account, we have cash going up by 5,000, which means current assets goes up by 5,000 because cash is a current asset. But accounts receivable, which is also a current asset, goes down by 5,000. So current assets goes right back down by 5,000. And so current assets doesn't change. The denominator doesn't change. And so the ratio, no effect. So we did 12. Let's see. 13 was, I gave everyone credit for that question because it was about the standards of ethical conduct, which I told you didn't have to look at those PowerPoints, even though they are important. Just extra stuff at the very end of the PowerPoint presentation I didn't want you to have to look at. I think it was in one of the appendices to the chapter. But let's see. 16, the study of an individual financial statement item over several accounting periods is called horizontal analysis. Like you see, how is net income performed? How is net income? What's the company's net income been over the last 5 years? And you look at like a trend or something like this, or that's horizontal analysis, where you hold the financial statement line item constant and you vary time. $17, direct cost. What is a direct cost for a company that produces motorcycles? Well, seats used in the motorcycles is definitely a direct cost because we can directly trace the cost of those seats to each motorcycle. Like we know exactly for a given motorcycle how much we paid for the seat, assuming we bought the seat from a supplier. Rent of the manufacturing facility that produces motorcycles, that is not a direct cost. It's a product cost, but it's part of manufacturing overhead, so it's an indirect cost. We can't figure out what portion of the rent for the facility this month was paid to produce a certain given motorcycle. It's not directly traceable. So A is a direct cost. D is a direct cost. Wages of motorcycle assembly workers. We know for each motorcycle that was produced, we know what wages were paid to the people that worked on that particular motorcycle. Because a person, when they work on the assembly line, they clock in, they clock out, so we know exactly how much time they spent working on that particular motorcycle for each motorcycle, and we know what their wage rate is, so we know exactly how much labor costs we incurred for them for their work on that particular motorcycle. So C is correct. So we did 17. Let's do 21. What is the company's current price to earnings ratio? I believe this, according to the formula sheet for Chapter 9, this is Chapter 9 question. It's the company's market price per share for their common stock divided by their earnings per share. And their earnings per share is itself a formula. Earnings per share is their net income minus the preferred dividends that we've paid divided by the average number of common shares. So we got to compute that first. So net income is 93.6. Preferred dividends are 11,900. Average common shares is 19,000. And so we earned per share this year $4.30 per common share. Our earnings per common share were $4.30. Because here's our earnings. And from that we subtract any dividends we gave to the preferred shareholders, which leaves the earnings left over that we could give to the common shareholders. Divide that by the number of common shares. That's what we earned per common share. Now plug that in right here in the denominator. And in the numerator, put our market price per share for the common shares. That's not relevant. So each share, if somebody were to buy our shares, they would have to pay $79 to get a share. And once they own the share, that share, we would be earning for them per share they own $4.30. So our company is probably overvalued. So our price to earnings ratio is just 18.37. Notice dollars per share cancel. And so the units of this guy right here, there aren't any units. It's unitless. It's just a number, 18.37. Our price is 18.37 times greater than our earnings per share. I guess let's do 23. Mitchell Company sells its product for $100 a unit. The company's accountant provided the following cost information. What is their break-even point in units? So profit equals revenue minus variable costs minus fixed costs. Set it equal to 0 and solve for Q to get the break-even point. That's how you find the break-even point. It's the Q that makes the profit 0. So our P is 100. So that's our revenue, 100 times Q. And our V well, let's see here. Our variable costs, our variable manufacturing costs are 45% of sales. So 45% of 100 is 45. So our variable manufacturing cost per unit is 45. Our variable selling cost per unit, 20% of sales. So 20% of $100 a unit is $20. And our variable administrative costs per unit, 10% of sales. So 10% of 100 is $10. So our V looks like 75, 45 and 20 and 10. So each unit costs us $75 to produce. $45 for manufacturing costs, 20 for selling costs, and 10 for administrative. So this is our overall V right here. So those are our variable costs. We multiply V by Q. And then so our fixed costs, well, we have $25,000 for manufacturing fixed, $15,000 for selling fixed, and $25,000 for administrative. So if you add that up, I guess you get 65. So those are our fixed costs. Set that equal to 0. So this is our profit. Set it equal to 0 and solve for Q. So we have 100Q minus 75Q equals 65,000. 100Q minus 75Q is 25Q equals 65,000. And therefore Q must equal 2,600 units is the break-even point. So we did 23. Let's see. Let's do 29. The average cost to produce 1 unit. So the product cost per unit. The product cost is the direct materials cost plus the direct labor cost plus the manufacturing overhead cost. Divide that all by the units produced to get the product cost per unit. So materials are 43,590. Direct labor is 19,300. And lease payments and utilities on the production facility amounted to 8,300. That's manufacturing overhead. General selling and administrative expenses were 9,300. That's not a product cost. That's a period expense because it does not occur in the factory. Divide by the units produced right here. And that ratio will be our average cost to produce 1 unit. We don't care about how many units we sold, and we don't care about our selling price. That's not relevant to answering this particular question. So 43,590 plus 19,000 plus 8,300 is our total product cost divided by 6,300 units. 11.25 a unit. Must have done something wrong. 43,590 plus 19,300 plus 8,300 divided by 6,300. 11.3. Let's see. 31. What is the company's quick ratio or acid test ratio? Again, you got to go to the formula sheet for chapter 9, that big formula sheet. Don't forget to bring your formula sheet to the exam. But the quick ratio is not all the current assets, but just 3 of them. Cash plus the receivables plus the marketable securities divided by current liabilities. That's the quick ratio. So cash's balance is 7,000. Accounts receivables balance is 13,150. And marketable securities, I don't see that listed in the current assets section. These are all the current assets. Those are both long-term assets. Marketable securities would be in the current assets section. So since it's not there, its balance is 0. And then divide by the total current liabilities. These are the 2 current liabilities. That's a long-term liability, and these 2 are stockholders' equity. So we got 3,210 accounts payable plus 7,530 salaries payable. So let's see. So 7,000 plus 13,150 plus 0 divided by the sum of 3,210 and 7,530 gives us a quick ratio of 1.88 when you round to the nearest 2 decimal places. Let's do 32. Then we're going to go ahead and do 33, 34, and 40. And then we still have 4 left to do to get 20. Well, maybe we won't do 20 for Chapter 2. We'll see. Fan company has not reported a profit in 5 years. This year, the company would like to narrow its loss to $16,000. Assuming its selling price is $41.50 a unit and its variable costs are $29, how many units must be sold to achieve its target, given that total fixed costs are $62,000? So we want our profit to be negative $16,000. So profit equals price times quantity, which is the revenue, minus the variable costs, which are variable cost per unit times quantity, and then minus the fixed costs. So all we have to do is solve this equation for Q. And that'll be the number of units we need to sell to achieve this target profit. So we got negative 16,000, add 62 to that. So we got 46,000 over here equals, and then we got 41.5 minus 29, which is 12.5, equals 12.5 Q. And therefore Q equals the 46,000 divided by the 12.5. 3,680 units. Let's do 33. Based on the following cost data, what conclusions can you make about the costs of product A and B? The costs, the total costs of product A and B. So up here we have total cost information, and down here we have unit cost, the per unit cost. So the total cost of product A at 10 units is $100. When we make 100 units, the total cost of product A is $1,000, and when we make 1,000 units, the total cost of product A is $10,000. So clearly the total cost of product A varies with production. So C is wrong, D is wrong. We're left choosing between A and B. The costs of product A are variable. What about the total cost of product B? Are they variable with respect to production? Well, we can't tell from the total cost information, but from the unit cost information, we can be able to get this. So the per unit cost, in other words, to make 1 unit of product B costs us $10,000 when we're making 10 units of B. So 10,000 times 10 would be the total cost of B, which would be $100,000. When we're making 100 units of B, it costs us $1,000 per unit to make B. So what's the total cost to make B if we're making 100 units? $100,000. And then if we're making 1,000 units of B, our cost per unit is $100. So what's our total cost? Again, $100,000. So it looks like the total costs to make B, regardless of how many units, stays the same. So the cost to make A, the total cost to make A are variable, and the total cost to make B are, so these numbers we've solved for these question marks, are fixed. So that rules that out. 34. Based on the above information, select the correct statement. This one is a little bit tricky. Let's see if A is correct. If we sell 20 units for $540 each, we'll have a profit of negative 200. All right, let's see. P times Q and then that's our revenue. And then our costs VQ plus F we can just go ahead and just sum up our costs. We don't have to write it as VQ plus F, but salaries, total salary cost at 20 units is 6,000. COGS at 20 units is 14,000. And then depreciation at 20 units is, we got 120 a unit times 20 units is whatever. So our total costs are 6,000 plus 14,000 plus 120 times 20. So 22,400. And our revenue at 20 units is 10,800. So minus 22,400. We have negative 11,600 would be our profit, not negative 200. So A is wrong. Let's see B. Depreciation cost is a variable cost. The total depreciation cost at 20 units is 120 times 20, which is $2,400. The total depreciation cost at 40 units is 60 times 40, which is $2,400. And the total depreciation cost at 60 units is 40 times 60, which is also $2,400. So depreciation cost is a fixed cost, not a variable cost. So it's really between C and D. Salary cost is a mixed cost, or COGS is a mixed cost. Let's see if COGS is a mixed cost. So a mixed cost, if cost of goods sold is mixed, then the cost of goods sold should be able to be written in this form, where we have a variable component and a fixed component, where A and B are constants. Q varies. Q is 20, then 40, then 60. So can total cost of goods sold be written like this? Total COGS at 20 units is $14,000. So if we take $14,000 divided by 20, we get $700 per unit. Total cost at 40 units is $28,000. If we take $28,000 divided by 40, we get $700 per unit. And $42,000 divided by 60 is also $700 a unit. So it looks like cost of goods sold can be written by this equation, 700 times Q. Then when Q equals 20, COGS equals 700 times Q. When Q equals 40, COGS equals 700 times Q. And when Q equals 60, COGS equals 700 times Q. So cost of goods sold is not a mixed cost. Cost of goods sold is purely a variable cost. There is no fixed component. It's just a variable component. A is equal to 700 and Q varies with 20, 40, 60 as you see. So cost of goods sold is a variable cost. So D can't be right. And so by process of elimination, C is correct. Salary cost, you can write it in this format, AQ plus B. There's a variable component and a fixed component. And to figure that out, you just take the total and divide it by the units. And you won't get the same per unit amount like you did with COGS. You'll get a different amount, which means that you can write salary like this. Salary cost can be written like this. Let's go ahead and do so let's see, we need to do 40, but let's see. Should we do anything else in between? I guess let's do 38. And I guess we'll do 39. And then we'll do 40. And we won't do 20 questions from this chapter. So 38. What is the company's net income or profit? Profit again is price times quantity or revenue. Let's see. They give us revenue right off the bat. We don't have to do P times Q. They just tell us it's 109,000. And then do they give us, they don't give us V. So we shouldn't do V times Q. Like you would think V times Q minus F. They just give us, they give us the costs. Direct labor wages is 33,400, so that's a variable cost. Go ahead and subtract that. Sales salaries and commissions is a variable cost. Go ahead and subtract that. Depreciation is a fixed cost. I mean, we can go ahead and subtract it because it's got to be subtracted. Rent on manufacturing facility is a fixed cost. Go ahead and subtract that. Administrative supplies and utilities is a variable cost or fixed. It doesn't really matter, but it's a cost. Go ahead and subtract it. And so that should be our net income. So this actually is pretty easy. So 109 minus 33.4 minus 25.4 minus 3.04 minus 4.04 minus 5.4. $37,720. What did I do wrong? Oh, I forgot to subtract the direct materials cost, 17,400. So go ahead and subtract that as well. I mean, it's all the revenues minus all the costs. That's net income. 20,320, which is what we got there. $39. Kraft Incorporated normally produces between 120,000 and 150,000 units a year. Producing more than 150,000 units alters the company's cost structure. For example, fixed costs increase because more space must be rented and additional supervisors must be hired. The production range between 120 and 150 is called it's the relevant range, and we talked about that in class. Remember we drew this up on the board where if we have cost up here and we have activity here, or volume, quantity if you will, when volume is between the 120 and the 150,000, then the cost remains fixed. But then if we go above 150, like between 150 and let's say 180, then it's fixed in that range, but it jumps up by a little amount. So it's stepwise fixed. So this right here is the relevant range. Over this range, the costs are fixed. But if we go over a different range, the cost actually increases. So 40, Benson Company received cash of $1 million from issuing common stock at par. As a result of this transaction, the debt to equity ratio will do what? So from the formula sheet, the debt to equity ratio is total liabilities over total owner's equity. And when we receive cash of 1,000 from issuing stock, cash goes up, $1 million. Cash goes up by $1 million, which means assets go up by $1 million. And then we're issuing stock, so common stock goes up by $1 million, which means owner's equity goes up by $1 million. And that's all that happens. So the denominator down here goes up by $1 million. and the numerator is not affected, so the ratio decreases. And that's it for chapter 20. I'm sorry, for exam 2. Let's go on to exam 3 now. I'm running out of steam here. So maybe we'll just do 10 questions from exam 3. Let's do question 2. This is one of the 10 most missed questions. Compton Company expects the following total sales for the first quarter. No, not for the first quarter. It looks like for the second quarter of the year. March, April, May, June. Not even the second quarter, but for these months, these are the expected total sales. What's the question? The budgeted accounts receivable balance at the end of May is what? All right. So in May, we expect to sell $30,000 worth of our product. 60% of those sales will be credit sales, and 40% will be cash sales. And then the credit sales are collected as follows: 30% in the month of sale, 70% in the month following the sale. So we only have an account receivable with a credit sale, right? So at the end of May, 30,000 is our credit sales for May, times 60% of that. I'm sorry, 30,000 is our total sales for May. So this is our credit sales for May, the sales for which we have an account receivable. And as of the end of May, what amount of this will not be collected? 30% of this will be collected. 70% will not be collected as of the end of May. So this should be our account receivable balance at the end of May. Now in April, this is our total sales. 60% of this is credit sales. And of that 60%, how much would be collected? In April, 30%, and in May, 70%. So by the end of May, all of this from April will have already been collected and will not be part of accounts receivable. So the only thing that's a part of accounts receivable as of the end of May is related to this number, like this. So get the credit sales, and then of those credit sales, figure out how much of that will not be collected as of the end of May, 12,600. So that'll be our account receivable balance at the end of May. Number 4, Howard Company provided the following selected information about its consumer products division for the current year. Based on this information, the division's investment amount was, so from the formula sheet, residual income is equal to our current operating income minus the minimum required operating income we need to earn on our investment to generate the minimum ROI. So our residual income given to us is $30,000. Our current operating income given to us is $150,000. And at minimum, we need to earn 12% on our investment, on our operating assets. And so we have this equation, and all we have to do is solve for OA, and that'll be the investment amount or the operating assets. So let's put 0.12 OA on this side, and then subtract 30,000 over here. Just do basic algebra. So we're left solving this equation, and so our investment amount must be, it looks like $1 million. So our total operating assets must be valued at $1 million. That's what we paid for operating assets. And on that, we need to at least generate 12%. So $120,000 is what we need to at least generate. We're currently generating $150,000, so we have a residual or an excess income, an income above and beyond the minimum we need to earn of $30,000. in the questions we did in class on this, usually I'll give you operating assets, give you this, give you this, and then you need to find the residual income. But in this question, they give you this, they give you this, they give you this, and they don't give you the operating assets, and they ask you for the operating assets. Let's do number 6, I suppose. Excuse me. So we may end up doing a few more than 10. We did 2, we did 4, we're going to do 6. Then we're going to do 7. Excuse me, after that. Hilliard Company budgeted the following transactions for April of year 2. Let's go ahead to the question because there's so much given information. The surplus or shortage of cash before considering any borrowings in April would be what? So let's see. Our beginning cash balance is $50,000. To that, let's add what we expect to come in the month in cash. So here are our sales, but that's total sales. 75% will be collected in the month. So so this is our total cash available that we budget to spend. And from that, let's subtract our estimated expenditures, which would be these 3 things. We don't have to pay cash for depreciation. It's an expense, but it's not an expense that involves us ever having to take money out of our pocket and pay. So we have a beginning cash balance of $50,000. To that, we're going to add $150,000. So we're expecting to be able to spend $200,000, and we're going to need to spend $105,000 according to the budget. $75,000 and $15,000. And so just based on that, we would have a $5,000 surplus if we only wanted to have a zero balance at the end of the month. But we desire to have a $25,000 ending cash balance. And so if we're sitting here with a $5,000 estimated balance, but we need a $25,000 balance, we must have a shortage of $20,000. So we're going to have to borrow money if we don't want to have this shortage based on this budget. Number 7. How much cash did we pay for operating expenses during the month? Sales commissions expense are paid in cash in the month following. So in January, we're looking at January here. This question's about January. This would not be paid in January in cash. It'd be paid in February. That would be paid in January. 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 And depreciation is an expense, but it never involves paying in cash. We've already said that. So you just add up the 4 items that I've circled. It said all other expense items that require cash payment are paid in the month in which they are recognized. So $40,000 plus $2,800 plus $7,200 plus $1,800 is the answer. $12. If actual production totals 8,200 units, so that's actual Q, then the flexible budget would show total costs of, so the flexible budget's total costs, we have the variable costs on the flexible budget, which are the product of actual quantity and budgeted per unit variable cost. And then we have to add the budgeted fixed costs. So these are the flexible budget total costs. Sorry, I was getting tired in the position I was sitting in. I had to change positions. All right, so these are the flexible budget total costs. So we're given a static budget. We have budgeted Q here. So this right here is P hat times Q hat, because static budget uses the budgeted Q and the budgeted per unit amount and budgeted fixed costs. This is the budgeted fixed costs. This right here for variable costs is the budgeted variable cost per unit times the budgeted quantity. And so if we divide this by the budgeted quantity, we'll get V hat, which we need. So we do $4,000 is our budgeted static budget fixed variable cost divided by a budgeted quantity of 8,000 units gives us a variable cost per unit of 50 cents from the static budget. That goes there. This goes here. And then the fixed costs go here. So we got 0.5 times 8,200 plus 4,000. That's our flexible budget total costs. $4,100 here. So 50 cents a unit from the static budget times 8,200 actual units produced plus 4,000 static budget fixed costs gives $8,100. Let's jump to 30. Actually, let's stay here. Let's do 16. I just did 12. Anne is trying to decide which one of the two job offers she will accept. Several items are presented below. We got two job offers. She's trying to decide between the two. Select the items that are irrelevant to Anne's decision. The base salary is irrelevant because it doesn't differ between the alternatives. Overtime compensation is relevant to her decision because for one alternative, she gets comp time and the other alternative hourly rate. So since that differs between the alternatives, it's relevant. So that's irrelevant. That's relevant, therefore can't be an answer to the question. Moving allowance is irrelevant because it does not differ between the alternatives. Signing bonus is relevant because it differs. And job search costs incurred, you might think, well, it must be relevant because it differs between the alternatives. But it's still irrelevant. So to be irrelevant, it either has to not differ between the alternatives or it has to be sunk. And in this case, job search costs incurred, the word incurred, past tense, means it's sunk. We've already incurred $300 to search for job A and $500 to search for job B. So now that we're deciding between the two jobs, what we spent in the past to find job A or what we spent in the past to find job B is not relevant to our decision now because that stuff is sunk. Whether we choose A or B, we still have spent those amount of money, $800 total. So that's irrelevant as well. So D is the right answer. 1, 3, and 5 are irrelevant to her decision. Now let's go to 30. I'm just going to jump all the way ahead. I made sure to do the 10 most missed questions and then I did some other ones for each chapter. Service Pro provides two kinds of services. We're going to do 30, 32, 35, 38, 39, and 40, and then I'm probably going to call it. 30, Service Pro provides two kinds of services. During the most recent accounting period, the two service lines produced the following operating results. If the company stops providing service 2, what will happen to the company's overall net income? So it looks like service 2 is currently operating at a $3,500 loss. And so it looks like if we nix service 2, then the overall company income will go up by 3,500. And you would say, oh, it must be B. But if we look more carefully, what is the true income of Service 2? It's not negative 3,500. What's the true profit of Service 2? It's not negative 3,500 because this particular line item right here, because it says facility level costs, this $12,000, we've allocated half of it to Service 1 and half of it to Service 2, and made it seem like if we get rid of Service 1 and 2, then we get rid of this $12,000. Or if we get rid of Service 2, we get rid of $6,000 of it. But that's not true because it's a facility level cost, which means we have that cost regardless. So that's not relevant. So really, all these other things are relevant though for Service 2. If we get rid of Service 2, we definitely would get rid of this revenue. We would get rid of these costs. So this right here is the true income of Service 2. So one way to do it, just do 25,000 minus 3 minus 15 minus 4.5. Or you could just take our negative 3,500 and add back $6,000. Add this 6,000 that was subtracted to get the negative 3,500, add that back. And so Service 2's true net income is $2,500. So if we get rid of Service 2, the overall company's income will go down by $2,500. $32. If the company accepts the special offer, what will happen? Well, this is if you remember the formula sheet for this chapter, I think it's chapter 13. So it's the formula sheet for exam 3. Remember chapter 13, we went through 4 decision-making contexts, and one of them was, do we reject or accept a special offer? So if you go to the formula sheet, it'll give you the shortcut to answer that question. And you'll see that we need to compute the relevant revenue from accepting and compare that to the relevant cost of accepting. The relevant revenue of accepting this special order is $33,000. That's relevant because if we accept the special order, we get $33,000. If we don't accept it, we don't get $33,000. So that's the relevant revenue. The relevant cost of accepting. If we accept the special order, we're going to have to incur costs of 42 cents per square foot for materials, 49 cents per square foot for labor, and 32 cents per square foot for variable overhead. All that multiplied by the job size, which is 46,000 square feet. That's our relevant cost. This here is facility level cost. So whether we accept the special order or don't accept the special order, we still have this cost. Now they've tried to allocate it per square foot to get you, try to trick you, to make you think that's extra money you have to spend for these 46,000 square feet, but it's not. So there we go. So the relevant cost of accepting is 0.42 a square foot for materials plus 0.49 for labor plus 0.31 or 0.32 for overhead. $1.23 times 46,000, 56,580. And the relevant revenue is 33,000. So if we accept the special order, whoops, I'll just do 56.58 like this. Then our income will go down 23,580. We'll lose 23,580 on the job. $35. Jump all the way. If the company decides to make the parts, total costs will be what? Will be less than cost of purchase, more than cost of purchase. So again, we're back to a decision-making context. This context is the make or buy decision. You go to the formula sheet, look at the shortcut that you're supposed to do to make this decision, and you'll see that for the make or buy decision, we need to compare the costs we could avoid by buying to the cost of buying. This is usually the easy one to get. The cost of buying are 29 per switch times the 6,000 switches. And we're currently buying. So this is our cost to buy the 6,000 switches. $174,000. Now we're trying to decide, should we stop buying and start making them in-house? Right? That's what it says here. So what costs could we avoid by buying? Well, that's the cost of making, right? If we buy, we avoid the cost of making. So what are those costs? What are the costs of making? $5 a switch for materials, $4 a switch for labor, $3 a switch for unit level overhead. All times 6,000 switches. That's one cost that we could avoid by buying. And then batch level setup cost of $37,000 per batch, and 6,000 units constitute a batch, and that's how many units that we're talking about. So just plus 37,000, we could avoid that. If the batch level setup cost was 3,000 units a batch, and it was $37,000 per batch, then we would have to do this 37,000 times 2, because there'd be 2 batches worth right here of batch setup costs. But thankfully, the batch size is exactly how many we're making, or how many we're currently buying. And then if we start making the switches, we do have to have a supervisor to supervise the making process, and we're going to have to pay him a salary. So we could avoid that cost by buying these switches. And then we cannot avoid this cost by buying. Whether we keep buying or we decide to start making, the facility level costs are the same. We can't avoid it. So that would be the total cost that we could avoid by buying. But there is another cost in here. If we make the switches, then space that we're currently leasing to another company for $2,700 a month, we wouldn't be able to lease that space anymore because we'd be using it to make. So that's another cost, an opportunity cost of making. Not being able to get this revenue if we make. That's an opportunity cost of making, or it's a cost that we could avoid. We can avoid that by buying. And so if we decide to make the parts, total costs will be, so what are the total costs we could avoid by buying, which is the same thing as the cost of making? We got 5 and 4 and 3, which is 12 times the $6,000 switches. It's $72,000 plus $37,000 plus $43,500 plus the opportunity cost of $2,700 times 12. So $184,900. This is the cost we could avoid by buying, aka the cost of making. And this is the cost of buying. So if we decide to make the parts, it's going to cost us $10,900 more than just continuing to buy them. So we should not make them. We should keep buying them. 38. The following static budget is provided. What will be the overall volume variance if 13,200 units are produced and sold? So that's the actual Q. So the overall volume variance is the difference between the flexible budget net income and the static budget net income. If it said the overall sales volume variance, then that would be the difference between the flexible budget sales revenue and the static budget sales revenue. But if it says overall, that means overall difference between flexible budget net income and static budget net income. So static budget net income is $130,000 given to us, right? Flexible budget net income or profit is given by, so the revenue is P hat times actual Q. The variable costs are V hat times actual Q. And then the fixed costs used in the flexible budget are the same as the fixed costs used in the static budget. So we need to get P hat. P hat is this. Q, actual Q, is this. So that's the flexible budget revenue. Flexible budget variable costs, V hat times Q. There's two types of variable costs, manufacturing and selling and admin. The manufacturing estimated cost per unit, 30. The selling and admin estimated cost per unit, 20. So add those together and you get our total V hat of 50. Times a Q of 13,200. So that would be the estimated, that would be the flexible budget variable costs. And then the flexible budget fixed costs are the same as the static budget fixed costs. We just need the total here. So this would be flexible budget net income, and then subtract the static budget net income, and we have the overall volume variance. I guess we can do this little piece. 70 times 13,200 minus 50 times 13,200. What's common to both of those? 13,200, so you can pull that out. We should have 13,200 times the difference between 70 and 50. So 264,000, I guess, would be our contribution margin from the flexible budget. Minus the 170,000 fixed costs is 94,000. So we have 94,000 minus 130,000. And so we have an overall volume variance of negative 36,000, right? So it rules that out and that out. So is it favorable or unfavorable? Well, it's a net income variance. So net income behaves kind of like a revenue. So if the number is positive, then if the variance is positive, then it's a favorable variance, and if it's negative, it's an unfavorable variance, because net income behaves like revenue. $39, and by the way, I should put, like I've done this before in class, but there's a little table you can memorize regarding variances so you don't mess up the unfavorable favorable thing. If the sign of the variance is positive, if the sign of the variance is negative, if it's a revenue variance, if it's an expense variance. So this is what you need to know about the variances in terms of interpreting them in the end. If it's a revenue variance and the sign is positive, then that's favorable. If the sign is negative, that's unfavorable. If it's an expense variance and the sign is positive, that's bad. Right? Actual expenses minus budgeted expenses, that's the variance. And if that is positive, that means we actually spent more than we should have spent. So that's bad. And if it's negative, then that's favorable. So if you just memorize this. And net income as a the variance of the net income variance, net income behaves like a revenue. If it's a cost variance, then that's going to behave like an expense, and then this will apply. But if it's revenue variance or net income variance or a contribution margin variance, like if we did the variance between the static budget contribution margin and the flexible budget, the flexible budget contribution margin and the static budget contribution margin, which would be the overall contribution margin volume variance, then that would behave like a revenue variance. If it's positive, that would be good. If it's negative, that would be unfavorable. So you can use this. 39 and 40, and then we're done. What is the amount of sales commissions payable that the company will report on its budgeted balance sheet at the end of the fourth quarter? How much do they estimate they'll still owe their sales commissions people for their sales commissions? So the only thing that's relevant to answering this question is this line and then this line. So it says 100%. So this is our budgeted selling and administrative expenses up here, and here's our schedule of cash payments for selling and administrative expenses. So at the end of the quarter, so in December, we budget $5,300 of sales commissions expense. And what will we pay in December for sales commissions? We'll pay 100% of the prior month's sales commissions. So we'll pay the $5,500 sales commissions expense in November. We'll pay that in December. This number will be $5,500. This number will be the $5,000. And this number must have been September's sales commissions expense. All right? So in December, we're paying, this would be the $5,500, we're paying the November sales commissions expense. So at the end of December, this has already been paid, this has already been paid. Right here, it was paid here, it was paid here. But this right here, it has not been paid. So as of the end of December, that's the balance in sales commissions payable. We'll pay that in January. 40, select the correct equation format for the purchases budget. So purchases budget, so our estimated or our required purchases that we usually make on account. There's a formula for that. This is a chapter 14 thing when we did that spreadsheet in class. You can go back and look at that spreadsheet, the purchases budget, and you'll see this formula's built into it. You'll see it if you look carefully. But what dollar value of, let's suppose we're a retailer, right? We buy inventory from a supplier, then we market the price and sell it. So the first budget we make is our sales budget, which is an estimate of what we think we're going to sell. And then after that, we can make our purchases budget. What dollar value of inventory are we going to buy on account? Do we budget to buy? Well, we at least need to buy the dollar value of what we expect we're going to sell. Then we also need to buy any desired ending inventory that we want to have left at the end of the month, like as an extra buffer or cushion in case sales are greater than expected. And that would be it. But if we already have inventory sitting there at the beginning of the month, then we don't have to buy that. So we may as well just subtract the beginning inventory. And this is our required purchases on account. This is the formula for it. So B. Cost of budgeted sales plus desired ending inventory minus beginning inventory equals required purchases.